Risk. A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. It's, of course, Tuesday as we get this Tuesday edition underway and talking a little bit about markets. And again, this has been kind of one of the key issues. Obviously, everybody's trying to figure out what's going on with the markets, right? It's just, are we in a bear market? If you talk to, the kind of the mainstream media, they're adamant that we're in a bear market, but yet we're not really. Markets aren't, the technical measure of being in a bear market is stocks are down 20% or more, and we're not even down 20%. I mean, we're just kind of flirting around that level, but, again, if we take a look at, kind of longer term trends of the markets, I mean, we're still in a very bullish trend from the 2009 bottoms. It's hard to say you're in a bear market when you're still above the 2020 peaks. So you had this very, sharp advance because of $5 trillion in liquidity. And again, markets have certainly sold off a bit this year. But again, still 20% above, still above the peak, even with this, kind of this 20% decline. So, markets feel terrible. I, absolutely agree. I mean, it's just been a crappy year to try to manage money. But it's not the end of the world. And while markets are down a bit, it's really been dependent more on what type of assets that you were invested in. If you were invested in cryptocurrency, it's been a heck of a bad year. Right. If you were invested in, the ARK type funds, it's been a terrible year. And if you looked at those, those assets and said, hey, that's the market, then yeah, we're in a bear market because those are down, 50, 60, 70%, right? But if you just take a look at the major indexes, they're not down that much. And so while it seems terrible, this is where we've got to be careful, is that while it seems terrible, right, the world just seems terrible, right? And it's not just, the markets, it's the economic data, it's the political divide, it's just, social media is just, hate after hate after hate, headlines. It's all about bad stuff. No matter where you look, you're just kind of inundated with news. By the way, whatever happened, or when did it happen? I remember growing up, right? You had news 3 times a day, right? You got up in the morning, you had the morning news, got you off to work. You had news at 5, and then you had news at 10. And it was important because the news in the morning told you what happened overnight. The news at 5 told you what happened between 9 a.m. this morning and 5, and then at 10 o'clock was the recap of what happened from 5 to 10. So, it wasn't this endless, push of news, what they call news. Right now, it's just anything they can throw up there to fill airtime, and that's really the problem as we stop reporting news and just trying to fill airtime. This is where opinions became a lot more prevalent. But this all impacts psychology, right? When you're regardless of your political leanings or whatever, right? I mean, if you're just inundated with just negativity all day long, right? You get negative. World's coming to an end, right? I get emails from people, dollars going to zero. Dollars is sitting at record highs, but okay, dollars going to zero. Inflation's going to kill everybody. Climate change, you name it. We've got all these problems, right? It's just negativity everywhere. So it's not surprising that that's just all kind of showing up, right? So now you've got inflation that's impacting the household, can't make ends meet, can't pay my bills. And then I turn on the news and it's nothing but negativity on the news and it's just everywhere. And so it's not surprising that it's showing up in investor attitudes or individual attitudes. Consumer sentiment has gotten very negative, right? Take a look at recent polls, right? Is the country going in the right direction or not? Those polls are at record levels of the country's going in the wrong direction. Why? Because everywhere you look, it's negative. It's not that bad. Yes, we have high inflation at the moment, but that'll go away. Inflation cures inflation. But this is all feeding back into how we view markets and assets. Now, and as I said, what's interesting here is that we have some of the most negative sentiment, not just by individual investors, but also by professional managers. I got a chart here of sentiment, and this is the net percentage of professional managers taking higher than normal risk, right? So right now, professional managers are not taking any risk whatsoever. In fact, the level of risk that professional managers are taking on right now is at the lowest level since October of 2008. That's Lehman. So, that tells you kind of the overall sentiment of what's going on. If we take a look at equity allocations, right? And looking at allocations relative to bonds, as an example. These allocations are also at some of the lowest levels we've seen since October of 2008. And again, just nobody's wanting to take any risk, right? And so it looks like it. And if you looked at this data, again, as I said in the first segment of the show, if I just showed you this data and said, hey, look at this equity allocation levels at the lowest level since October of 2008, you go, man, that's got to be a bear market bottom. It must be a terrible bear market. We must be in a terrible financial crisis right now. Right? Must be a massive recession. Things are just falling apart. Businesses going bankrupt. It's terrible. It's not happening at the moment anyway. Not saying it won't, but it's not happening now. But that's certainly the attitude. And again, this goes back to the point I was making, which is everywhere you look, it's just about as negative as it can get in terms of the way people think and feel and operate. And again, you're just inundated with negativity all day long. I mean, when's the last time you turned on television and somebody said something happy, right? It just doesn't happen anymore. And it's a shame. It kind of makes life miserable. But even social media has gotten to be the same way, right? You just get on social media and it's just negativity after negativity. So again, when we come back and looking at, how we position and how we look at things and how we manage money, et cetera, we've got to separate out this emotional bias that's going on right now. And again, lots of negativity, right? So the first inclination is, man, get me out of the market because I don't see anything good going on. Everywhere you look, it's negative, right? So just get me out of the markets. The problem with doing that, of course, is this is where these are the points, right? So now we look at this in the other manner. When things are so negative as they are now, this is the point to where we start getting surprised. If you take a look at a lot of the economic data, it's very negative. Forward expectations for economic data are very negative. Now, I'm not saying that the data can't get worse. Don't mistake what I'm saying. But what I am saying is that when expectations are extremely negative, it's much easier to have economic surprises In other words, the data is not as bad. And so markets tend to overcompensate. We tend to overshoot things. Now, I'm not saying that the market has done the work yet, but what I'm trying to get across to you is be careful. I'm getting a lot of emails from people talking about, I'm just out of the markets because, it's the world's coming to an end, right? It's not. It's not coming to an end yet. According to the climate change people, we have till 2030. By the way, did you know that not one single prediction of climate change has come true since 1950?
I was reading that this morning.
Interesting. Yeah. Also has a lot more to do with the sun than emissions, but that's a story for a different day.
Yes.
The war's not coming to an end. One of the things that may wind up surprising people is a reversal in the strength of the dollar. Now, that's going to happen eventually. The dollar is going to weaken relative to other currencies. What's going to cause that to happen today? Nothing, right? What's going to cause that to happen in the next week? Don't know. Next month? Who knows? But it is going to happen at some point. There's going to be a shift in dollar movement from the U.S. dollar back into other currencies, the euro, whatever it is, and because things ebb and evolve over time, right? So a reversal in the dollar could prove to be a fairly decent support for asset prices if that occurs. Now, when will that occur? I have no idea. But it's something worth watching and keeping an eye on the dollar because, again, 2 years ago, the dollar was going down and everybody was like, the dollar's terrible and the dollar's going to zero. And I was making arguments back then that, no, pretty much we're about to have a stronger dollar. And since then, we continue to have a stronger dollar. And I haven't heard from those people that argued with me since. But the dollar is going to weaken. Again, what causes it, I don't know. But it will weaken eventually. That could provide a relative support for asset prices, for risk on assets. We'll see what happens when that happens. One of the interesting dichotomies of this adventure has been, though, that normally when the dollar's getting stronger, commodities get weaker because commodities are trading the dollar everywhere else in the world. And when the dollar's going up, those commodities are much more expensive for foreigners to buy. And normally you have a reversal in commodity. This time, not the case. They've all kind of run together. So we'll see. Is this time different? I doubt it, but we'll find out. When we come back from the break, I want to pop on a topic here real quick about housing. Talk about that right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Inflation touches every aspect of your life. No one can avoid it because we're living in an inflation nation. RIA Advisors has a 9-step inflation battle plan, and we're sharing it with you in a special summer lunch and learn Thursday, August 4th at noon. Register now at realinvestmentadvice.com. There's no magic elixir against inflation. Our 9-step plan can help you blunt inflation's effects. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
It's really not fair. It takes you a long time to get into shape, and literally you just get out of shape 15 minutes if you stop doing anything. You're just,
That's right.
Out of shape again.
You can no longer get up off the floor.
Exactly.
The Real Investment Show podcast. Same show, your schedule.
The floor's getting much further down.
It is.
Every year the floor gets further away. I don't know if I'm getting taller or just older.
I've stopped picking stuff up. I drop it, it's staying there.
At realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
Talk a little bit about housing here for a minute. There was an interesting chart out this morning. I'll show you here in a minute. Talking about how long it takes to save up for a house, right? Save up a down payment for a house. And I thought it was interesting because the way that the chart is titled makes it sound like that's a bad thing. Like, oh my gosh, it could take people 10 years to save up for a down payment of a house. That's what it should be, right? Back in the day, as Brent and I say, back in the day was when there was only, two ways to die as a kid, right? Either natural causes or talking back to your parents. That's the day we're talking about, right? We're still talking about that. But back in the day, right, houses weren't that expensive, first of all, right? And that was because in order to save up for a house, you had to have a 20% down payment. There was none of this get two mortgages thing to avoid PMI insurance. It was just you saved up 20% for a down payment on the house, the bank would lend you the rest. That's just the way it was. And so house prices remained fairly moderate because people could only save up so much money for a house, right? And it took a while. It took my parents like 8 years to save up for the down payment on their house. And they were like squirreling it away, right? Jars under blankets and stuff like that, right? And that was the norm, right? And so when you went to the bank and you walked in there with your 20% down payment, you had skin in the game, and the bank says, okay, I'll loan you the other 80% for the house, but you had a 20%, chunk of that house that you own. So, you didn't want to lose that money. So people really focused on paying their mortgages, and they bought houses they could afford. And because of this situation, we didn't have, house price increases, and we didn't have these bubbles that we've seen over the last few years. And the reason that these bubbles have become more the norm is because we started doing all these crazy things, right? So you could get two mortgages. So you could put less money down, and you get two mortgages to avoid the PMI insurance. we started coming up with all these adjustable rate mortgages and, no income justification mortgages and these type, subprime loans. And, just anybody is like, we just had to get people into houses. And of course, when you create a lot of demand for houses because you're giving people money, then that means the prices of houses have to go up. And then when the Fed comes in and starts dropping interest rates, pushing interest rates lower to zero, that means that the money I'm spending on the house, I can buy more house. My monthly payment that I can afford, right? I can afford $500 a month. At 5%, I can afford a $150,000 house, but at 2%, I can afford a $300,000 house, right? So we all started buying more expensive houses. We all wanted to live like, the Beverly Hillbillies and have these big houses. And so now the average price of the house is over $300,000, right? And this is all caused by all this funny money that we've been doing with mortgages for the last, 20 years. And we wonder why. It's like we look around, it's like, man, why are houses so expensive? People are upset. I can't get into a house because every time I try to buy a house, somebody outbids me for it. Well, yeah, because, there's no requirements. I get a 3% down Fannie Mae mortgage. I don't have to save up a lot of money to get a Fannie Mae mortgage. And this is the consequences of loose fiscal and monetary policy. And I thought this chart, let me show you this chart because I thought it was interesting because, again, this chart makes it sound like it's a terrible thing. Number of years to save for down payments, first-time home buyers. And it says right now that it takes up to 10 years for somebody to save up for a house. It's terrible. That should just not happen. You should be able to walk out of college without a job and buy a house, right? No. And this goes back to, part of what we talked about in terms of capitalism, right? The American dream. And the American dream was never about owning a house. Somewhere, the real estate association came out, it was like the National Association for Real Estate came out, it was like, the American dream, got to buy a house, right? Yeah, because they want to sell you a house. That's their job. But the American dream is not buying a house. That's not, getting into debt and buying something you can't afford is not the American dream, right? That can turn out to be the American nightmare pretty quick and has for a lot of people. The American dream is coming to America with 2 nickels in your pocket and building something, right? We hear all these stories of people that have come to America with, very little money and they've created very successful businesses. And, I'm not talking about, the Musk of the world. I'm talking about people that built, very successful businesses, manufacturing companies, electrical companies, or whatever. And they've made a very decent life for themselves here in America from nothing, right? That's the American dream. And the trapping of that achievement, right? The measure of that success is when you have enough wealth saved up that you can afford to buy a piece of property, right? Buy a house. And being able to afford it being the key word, right? So I've built this very successful business. Now I can go out and I can buy my house. And I can put 20% down on it, and I can have a reasonable mortgage, and I can pay my mortgage because I have plenty of discretionary cash flow, et cetera, so forth and so on. The houses are not the American dream. The houses are a representation of your achievement of that American dream, right? That's where we've gone terribly wrong. And again, when you take a look at this chart saying, the number of years that it takes for people to save up a down payment of the house, it could be up to 10 years or 15 years. So what? Great. Make it 10 years, make it 15 years, however long it takes you to save up for the house. Great. Because when you go to buy the house, you can afford it. And here's what happens to housing if we would get rid of all these funny mortgages, right? And go back to, you can get one mortgage, it's 20% down, and you can go buy your house. Housing prices would stabilize and fall. and they would fall to a normal economic level. So instead of a house being, averaging $350,000, maybe we go back to $225,000 being kind of the median house, right? But then you stop having these bubbles. You'll get back into a more normal trend growth where housing prices are growing with the rate of inflation in the economy, which is exactly what they should do. Affordability comes back into line. People are not defaulting on their mortgages because they've got houses they can actually afford. Surprise. And if you can't afford a house, guess what you're doing? You're renting. And that's okay. That's another thing we've done here to individuals is like, renting is terrible. Should never rent a house. You're just giving somebody else some money. Well, first of all, the people that are providing the rental properties, yes, that's their business, and that's the way they make income, and they've been successful in saving up money, creating a business to build multifamily homes or to buy houses and turn them into rentals, etc. And that's okay. When you're renting, they're responsible for all the upkeep, the maintenance, etc. You just simply pay your rent, and guess what you're doing in the meantime? Saving up money for the down payment for your own home. It's okay to rent. Nothing wrong with it. It gives you flexibility. Don't like where you're living? Move. Right? Don't have to worry about selling anything. You just get to the end of your rental agreement and then you pack up and you move somewhere else you like better. Don't have to worry about selling a house, paying taxes, homeowners association dues, maintenance, upkeep, yard maintenance, pool maintenance, whatever it is. That's all done for you. There's nothing wrong with renting. But the National Association of Realtors doesn't like you to rent because, well, if you're renting, then you're not buying, and that means their real estate agents that they all support aren't making any money. See, everybody's got a hand in this game, and it's not necessarily for your benefit. There's nothing wrong with saving up money, right? There's nothing wrong with being required to prove that you can afford something. If you can, and see, that's the benefit of saving up 20% down payment. If you can afford to save a 20% down payment, guess what that also suggests? It suggests that you've got your household in order, that you're not living paycheck to paycheck, going into debt every month because you've had the ability to squirrel away a 20% down payment. So it suggests that your financial situation at home is in order and solid enough for you to be able to buy this piece of property, which is now going to require you to also be having to do all the maintenance, the upkeep, etc. If you take a look at recent polls, all these young millennials that ran out and bought homes, they're polling them now going, well, what did you think about your home purchase? Particularly these that bought them, after 2020 and 2021 with their stimmy checks. They took those down payments they got from the government, ran out to buy houses. Well, nobody told me I was going to have to, mow the yard and pay taxes and these homeowner association dues. Nobody told me about that. Didn't know I had to maintenance the house. Didn't know I had to mow the yard. The washer went out. Didn't have money for that. The dryer went out. Didn't have money for that. The refrigerator failed. Didn't have money for that. And so they're upset because nobody told them about all. It took everything they had just to get into the house, and nobody told them about the ongoing expenses. The great thing about a 20% down payment is, if you can get there, you can afford all the other stuff that goes with home ownership. Because homes are an expense. They're not an investment. All right. Be right back after the break. Wrap up a couple of things. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Inflation touches every aspect of your life. No one can avoid it because we're living in an inflation nation. RIA Advisors has a 9-step inflation battle plan, and we're sharing it with you in a special summer lunch and learn Thursday, August 4th at noon. Register now at realinvestmentadvice.com. There's no magic elixir against inflation. Our 9-step plan can help you blunt inflation's effects. Register today at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts
Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. Get ready to wrap things up. Futures are still kind of maintaining their upward bias this morning. Dow looks to open about 179. NASDAQ's up about 91 points. So we'll see how this kind of opens. You know, we saw this yesterday. Markets opened up nicely positive and then sold off as Apple came out yesterday saying, yeah, we're going to have to maybe stop hiring people. This is kind of one of the interesting things that we're seeing right now, along with a lot of the economic data, and not surprisingly here. And this is kind of the process that we go through in terms of employment, is that, you know, we start hiring a bunch of people and because we have all this demand. And then when we start to see the demand fall off, we don't want to fire the people we hired. Look, I really like Brent. He's really good at his job. I really don't want to fire Brent, right? So I'm going to do everything I can to keep Brent on payroll. See, this is going to make him feel better as long as possible because I can't replace Brent. Brent is literally irreplaceable. When he dies, it's going to be Weekend at Bernie's. Here at the studio, you'll see him, you know, just puppet strings and sunglasses, and Brent will keep working long after he's expired. The good news is it'll be for free, but he'll still be working long after he's expired. But so the first thing though that companies do is I don't want to I can't afford to get rid of these good employees because I won't get them back, right? See, if I let Brent go, Brent's going to have to get a job somewhere else. He's not going to go sit at home drinking Mai Tais. Well, he might because we pay him a lot. He's not going to sit at home waiting for me to call him back to work, right? He's going to get a job somewhere else. So I don't want to lose really good employees because they're very valuable. So the first thing I do as a business is I'm saying, okay, I'm just not going to hire any more people. I'm going to do everything I can to keep the people I have because they're expensive to hire and train. I'm going to hold on to them as long as I can. Then once you get the hiring freezes, then you start getting the terminations and layoffs. See, that comes a little bit later on down the road as demand deteriorates. And as we've talked about before, businesses are always slow to hire, slow to fire. But we're seeing more and more companies, particularly in the technology space, starting to institute hiring freezes. Tesla, Google, Apple, others. And so we're starting to see this all kind of maturing at one time. Well, yesterday's announcement, and again, markets were doing better yesterday morning, and then Apple comes out and says, hey, can't really hire any more people, suggesting that, you know, things are slowing down. Wait on the markets. And so we sold off. Now, this morning, again, like I said, we're going to try to rally here a little bit out of the gate. S&P futures up about 28 points right now. So we'll see if, you know, this can the market can kind of maintain this base it's in, or is there still more concerns about the economic data? The economic data is weakening, right? There's no way, nobody's denying that. The question is whether expectations have now gotten so negative that the economic data starts surprising to the upside. It's still bad, right? It's just not as bad. It's like the doctor coming in saying, well, we're going to have to amputate your leg, but the good news is only from the knee down. We thought we were going to take the whole leg, but just the knee down. It's still, right, it's still bad, right? That's terrible. That's a terrible analogy. I just couldn't think of anything faster off the top of my head. Terrible analogy. It's still bad, right? It's just not as bad. Terrible. Sorry. I just apologize for that. You get the idea. Let's move on. Good news is we're only have to take your head.
Amputate at the neck.
Exactly. But that's where we are, right? It's just, the news will still be bad. It just won't be as bad. And that's where markets may start to try to find some support. Well, if the news isn't as bad, maybe we've priced in most everything. I don't know, right? This is all guesstimates and assumptions right now. And this is why it's so important that we don't make long-range predictions about things. We simply just trade the markets for what they are and manage that risk accordingly. And these ideas of just, well, I'm going to buy something and sit on it, get you into a lot of trouble, particularly if it's the wrong set of assets. But so just kind of pay attention to this. I mean, we're definitely watching what's happening here with, the economy. Things are certainly slowing down. And, don't know where this gets to ultimately. Is this just a mild, this is the kind of the interesting point. 2 months ago, the media was saying absolutely no recession in sight. No way we're going to have a recession. Now we're looking at basically 2 quarters of potentially negative economic growth, much weaker than was previously expected, by the way. And now they're saying, well, maybe we'll have a mild recession. What's a mild recession, right? Is a mild recession where your neighbor loses their job, but you don't? I mean, what's a mild recession? Or is it going to be a more severe recession, right? That we have, more job losses and, a much deeper contraction of economic activity. Don't know. And this is what I'm saying is like, if you bet on something, and this is, again, I'm seeing a lot of people, emailing me and making comments, they're very one-sided on their bets, right? Oh, the world's about to end and I'm hedged for the apocalypse. Okay, great. You better have guns, ammo, and beanie weenies for the apocalypse because that's all that's going to matter. The problem with being hedged for the apocalypse is that apocalypses never happen. On the other side of the coin, the most optimistic outlooks generally never happen either. So reality always exists somewhere in between extremes. And that's where we've got to focus our efforts and our attention in terms of managing money and making that analysis on how much risk we take or how much risk we don't take. And this is why it's important. I was talking about the media earlier and how it's just everywhere you look on the media, it's just super negative, right? Well, that's the extremes, right? And reality is somewhere in the middle of these extremes, right? And all we see on the news is extremes of these reports. But reality is always somewhere in the middle. But reality is boring, and so nobody wants to report on reality, so we get all these extremes, and that warps and shapes our perceptions to us thinking that, man, the world must be a terrible place because, I was just watching the news, and the news said ABC. We're all going to die from climate change, the world's ending, and everybody in California now rules the world, whatever, right? The point is that we can't allow these extreme narratives to affect our investing because it'll make us make decisions that are psychologically inappropriate for our portfolios. And we talk about these psychological behaviors all the time: loss aversion, anchoring, where we get stuck on some former price level. Loss aversions where we're trying to just avoid losses. I can't take any more losses. I just got to get out. These are all behaviors. One of the biggest ones we get, of course, is confirmation bias. We only look at the stuff that, supports our opinion. So if we think the world's going to end, that's all we read, right? We read all the doomsday prepper blogs. So that's why it's always important. We've got to balance our views, balance our outlooks, step away from the headlines and do the analysis. And look, if you're managing your own money, it requires work. It's not as simple as just buying some stuff and hoping it goes up. That seems to be the case during bull markets, right? It can't go wrong. I was getting chastised in 2020 because I wasn't buying bankrupt companies, but they were going up, Hertz and stuff like that. But that's not investing, that's speculating, that's gambling, right? And that's not what we do with client money. We invest. And we're investing for the long term, right? We're trying to get those long-term returns. And we always talk about that. I'm writing an article on this right now about long-term returns and, the impact of what the Fed has done to return structures and why long-term returns going forward are going to be lower. But we've gotten used to this idea that the Fed is always there to bail us out. And this is I was talking about the FOMO earlier in the show this morning, talking about, before it was the FOMO of missing out on the upside. Now it's the FOMO of missing the bottom because the Fed is going to show up any day now to bail out the markets. And I don't want to miss that, right? Because when the Fed shows up to start bailing out the markets, these markets are going to take off screaming, and I don't want to miss the bottom. So I got to be in there. So Lance, just let me know where the bottom is so I can just put all my money. I'm going to back up the truck. I'm going to take out a home equity mortgage. I'm going to just throw it all in the markets. That's what we've been taught over the last decade. Because every time the markets do go through a correction, right, the Fed has shown up to bail it out. So we've been trained like Pavlov's dogs, right? Ring the bell, drool, get food. Question is can the Fed continue to do that? My suspicion is yeah. My suspicion is that at some point the Fed is going to come back and they're going to reverse quantitative tightening. They're going to go back to quantitative easing because that's the only bag of tricks they know. Now, it's not helping anybody. QE is a great wealth extractor from the middle class. It shifts wealth from the middle class to the wealthy, right? So it doesn't help anybody. It certainly doesn't help the economy. It makes the market look better. And if you've got assets to invest, good for you. But at some point, markets have to return to the rate of economic growth that the economy can actually generate. And that rate of growth is significantly weaker because of the debts, the deficits, everything else that we put on. Anyway, that article is coming up. I'm going to have that available for you probably next week. It'll be on the website, realinvestmentadvice.com. Get all of our latest blog posts. We have a blog post out this morning on ESG investing and its eventual demise and why we were talking about that a long time ago. The latest newsletter is out, our daily commentary. It's all at the website, realinvestmentadvice.com. Also, if you're a do-it-yourself investor, you can follow all of our models and our research at simplevisor.com. That's simplevisor.com. It's a completely digital platform, and you can even have the platform manage money for you. It's all at the website, realinvestmentadvice.com. See you back here tomorrow.
It's a rich man's world.